Partnerships. Think of a partnership like a business marriage, because when two or more people form a partnership, they are essentially married from a business standpoint. In other words, when two or more people engage in business activity and they have not filed papers with the state to become a corporation or an LLC, by default, that business is considered a partnership. In general, when we refer to partnerships, we refer to general partnerships, in which the general partners are personally liable for all business debts, including court judgments. More than that, each individual partner can be sued for the full amount of the business debt, and each partner can hold the other partner liable through the business. Also, everything the business and the partners own individually, it's also on the line in case of any conflict. In essence, a partnership, it's a lot like a sole proprietorship, but owned by several people, and all liability is shared to the partners. And if you ever have been in a bad relationship, you know the damage which can happen to you psychologically and financially to your financial well-being when the two partners disagree, they fight, or they want to end it on different terms. On the other hand, if you have been in a healthy relationship, a supportive and successful and beneficial relationship, you know that the benefits of the right partnership can be endless. To recap what I said so far, a partnership doesn't require lots of paperwork to start. From a taxation point of view, the partnership's taxes are 100% tied in the partner's tax returns, and the entity on its own does not pay taxes. In a partnership, all partners are liable personally for their obligations to the partnership. This is known as general partnership, in which any individual partner can bind the whole business to contract or business deal, or you can say that each partner has what's known as agency authority for that partnership. Next, there is also something called a limited partnership, which is the combination between a general partner and one or more limited partners. The general partner has the same role as in a general partnership. She or he controls the company's day-to-day operations, and it's personally liable for business debts. The limited partners contribute financially to the partnership, but they have minimal control over business decisions or operations, and normally cannot bind the partnership to a business deal. So they not can close any deals in the name of the business. So in return for giving up that management power, the limited partner gets the benefit of protection from personal liability. This means that a limited partner cannot be forced to pay off business debts or claims with personal assets, but in case of being sued, he or she can lose their investment in the business that they initially made or they made along the way. Let's see that that limited partner needs to stay out of the management activities of that company in order to maintain their limited personal liability. If they participate in any way in the control of the business, they can become liable as well, just as the general partner. Another kind of partnership, it's called a limited liability partnership, or an LLP. In some states, these particular partnerships are only available to professionals such as lawyers, accountants, or doctors, and are particularly well suited to them. Most professionals do not prefer general partnerships because they don't want to be personally liable for another partner's problems, especially in those cases involving malpractice claims. And I'm including this here because the coaching industry, it's still fairly new and not very regulated. However, malpractice claims may occur, and I want you to be aware of all structuring options possible that may benefit you. Also, we will discuss in detail liability insurance and that you will most likely purchase to cover yourself and your business. So when forming a corporation to protect personal assets may be too much trouble, and when some states won't allow professionals such as lawyers, consultants, or even coaches to form an LLC, The solution often is limited liability partnership. This business structure protects each partner from debts against the partnership arising from professional malpractice lawsuits against another partner. With this being said, I want to highlight how important it is to consider seriously who you want to get into partnership with. It's also very important that a lawyer will draft the partnership agreement, even though it's not legally required to do so, but I recommend it. Now, believe it or not, truth is, partnerships are not the most successful types of businesses, and it often happens that the partners go to mediation or they simply fight with each other for the smallest details. Regardless, if you decide that a partnership is good for you, here are a few good points to include in your partnership agreements and make sure that they are there in writing. You have to put in the full correct name of all partners, the date of the partnership creation, the time and money that each partner contributes. Please keep in mind that very rarely it happens that both partners can contribute equally in time and money, and this should be specified and agreed on from the beginning. Otherwise, it often happens that one partner ends up working long hours in the business and feels sooner or later like he or she is taken advantage of, becoming resentful of his or her partner. You also need to specify the duration of the partnership. How long these partners are going to share this business together. Also, it's important to clearly know the methods for making business decisions. Because let's be clear, somebody has to have the final word in case the partners disagree, which, believe me, happens pretty often in this type of structure. Another point on the agreement must be the clear sharing of profits and losses. Normally, that is directly proportional with the percentage of ownership. However, it may happen that one person may receive more than the other when it's about profit. This is a point of business to be agreed upon from the beginning, in detail, in writing, included in the partnership agreement. Another important factor is to include how to distribute these profits. For example, a partner may want to take money out of the business each month or every quarter, while the other partner may like to leave the money in the business while the business grows. This can be a huge reason for a fight later on. That's why it's very important to be clear and to put it in writing from the beginning. Specify, clarify everything. One more important thing to include in the agreement is the restructuring or dissolution of the partnership in case one of the partners becomes disabled or for any reason it cannot conduct the business operations anymore. Let's be honest here, none of us gets any younger. It's important to have everything in writing. So better write down from the beginning what's going to happen with the business when unwanted events like possible death or disability may arrive. At that point, there must be a specified way to evaluate the partnership for estate sales or cash out purposes, or maybe for redefining and keeping the business going. Of course, a lawyer may include all different specifics, or you can find a standard form online and make it your own. But either way, a simple handshake won't do in a partnership. I have attached to this lecture a sample of a partnership agreement between 3 partners, just so you have an idea of what a simple agreement should look like. However, I do recommend and I insist that for partnerships, you have a lawyer draft this agreement in order to protect your best interest.